Okay. Okay, so now that we got to take a look at the other two depreciation methods, so we learned units of production and we also got to take a look at double declining. Now, today we're going to be learning the last section of depreciation, okay? And like I mentioned earlier, 11.4, when we talk about amortization, right? Amortization is actually going to be depreciation, but in terms of intangible assets, okay? So very similar to what we've also learned and looked at before. We talked about how land never depreciates because land depletes. So same concepts going along here too, except it's just different wording, okay? Now, again, amortization is going to be closely tied and related to straight line. So if you are able to understand straight line, then amortization should just come easy. Okay, so let's go ahead and dive into 11.3, which is straight line and what straight line is. So again, we talked about the 5 components that are involved with in order for you to do depreciation. You need these 5 concepts, and the one thing that you need to know here is that yes, these are one of the depreciations that where time is very sensitive. Okay, so just because we got to take a look at it today, right? We looked at partial years. We're also going to be looking at partial years here as well. So whenever the date that you place into service is going to be calculated based on that many years. So go ahead and go moving forward. So here are the 3 depreciation methods again. Okay, so we know what those are. So straight line method. As I've mentioned it before, it literally is what it says its title is. You are going in a straight line. That means you are going at a constant rate. Same thing here, all right? The idea of why we use this method, or it's the most common one and widely approved by IRS, is because it's the concept where you are going in a straight line and you're spreading the cost of the asset evenly throughout its entire life. Okay, so when we're looking at an asset cost, right? We are literally going to take it, divide it by the number of years, and say that's how much I'm going to depreciate it every year. And that's exactly what the formula is going to reflect. So what we're doing essentially is we're taking the overall cost of the asset and spreading it across its useful life. So this now, because we've learned these concepts before, right? We've seen these formulas before. Now it's going to be a mesh between units of production and double declining. All right, except here are the differences. Here we see depreciation basis. It's going to be your asset cost minus your salvage value, which we got to take a look at that in units of production. Okay. Second thing that we're going to do is to determine the depreciation rate, which is 1 over the useful life. Except look at this one. Instead of multiplying it by 2, it's just only once. So we've seen this before in double declining, okay? Except we're not multiplying it twice. We're only depreciating it, or just in this case, we're only depreciating it once, okay? And then, of course, the depreciation expense is going to be depreciation basis times rate. And then, of course, like I mentioned before, your accumulated depreciation and your book value are going to stay constant. These formulas are never going to change. It's going to be the previous year's accumulated plus current year's depreciation expense, and then your book value is going to be the cost of the asset minus accumulated depreciation. So, like I said before, it's a hybrid, a mix between units of production and double declining, right? We get to take a part of one of one method and another part from another method and meshed it together to create straight line. That's not really how it happened, but just go with the flow with me, okay? It makes it easier because that's how I'm teaching it this way, okay? So let's go ahead and take an example here. So the example here, we have an asset, a machine that costs $15,000 with a salvage value of $2,500. Its useful life is 5 years, and the number of units it can produce is 10,000 units. And the date that we place into service is as of January 1st. So the depreciation basis here is going to be your cost of the asset minus salvage value, in which this case it is 15,000 minus 2,500, which gives you 12,500. Yes, good. Now let's go ahead and determine the depreciation rate. Here, we got 1 over the estimated useful life. So what is my estimated useful life?
5 years?
5 years. So what is 1 divided by 5? 0.2 or 20%. Good. All right. So now the simple equation here to solve for the depreciation expense is depreciation basis times rate.
So 12.5 times 20%?
Correct.
2,500.
2,500. Okay. So therefore, what's my accumulated depreciation for the first year?
10,000?
Well,
No, 2,500.
yes, it's yeah. All right. Yes. And then now what is your book value? Your book value is going to be the cost of the asset minus accumulated depreciation.
That's going to be the 10,000.
That's not 10,000.
Cost of the asset.
I'm sorry, it's 12.5.
Yes, it's going to be 12,500. So remember, don't take the depreciation basis. You never ever ever use the depreciation basis in this concept. It's always going to be asset cost, or cost of the asset. Okay. So there you go. All right, that was for the first year. So let's go ahead and solve for the second year. Well, I already solved it for you. So notice this. My depreciation basis, right, for the second year is going to stay the same, right? We got 15,000 minus 2,500, and it's going to be 12,500. My depreciation rate is still going to stay the same. It's 1 over 5, which gives you 20%. And then, of course, 20% of 12,500 is going to give you 2,500. And then here we just add our accumulated depreciation. And then now we solve for a book value. Now notice this. What's going to happen for the third year? It's going to reflect the same every year. So here, this is the one where you can assume, if I do this, then that means every year I'm going to depreciate the same exact amount. So therefore, the first 3 columns, if you solve for one year, all 3 columns are going to look identical. And that's why we call this straight line. It's a constant rate. It's a constant depreciation expense. You determine one, it's going to be the same every year. So this is why it is so much easier to use this, because once you determine one number, you just use that number throughout the rest of its life. Okay?
So it doesn't matter what time of the month you're putting it in use?
We're going to talk about that in a second.
Okay.
Because yes, that does matter when we talk. Yeah. But in this case, we place my asset in the beginning of the year. So that means every year I'm going to depreciate it for the same exact rate. And what you're going to notice is that at the end of its year, right, the depreciation basis should match your the 5th year's accumulated depreciation, and your salvage value should equal book value. But notice this, you don't need to do that much work, right? Because here in this case, we solved for one, we solved for all 5 already. Less work to do. No need for extra calculations. It's already been solved for us. Okay? And notice this, every year I'm depreciating it the same every year because it's a straight line, it's a constant rate. So, of course, when you journalize it, it's going to be the depreciation expense and the accumulated depreciation for the 2,500. That's for year 1. Year 2 is going to look identical. So that means every single year we make the adjustment journal, it's going to look the same. All right? Any questions in regards to straight line? Pretty easy concept, and I told you, this literally will only take 5 minutes of your time.
Yep, that is.
Okay? So with that being said, okay, now this is where partial years does come into play. It does affect the way that you make your calculations, but it's only the initial calculations that's going to be affected. Every year after that should reflect the same until you reach your last one, because your last one, obviously, if you only have 3 months, right? We have to understand that we have to also finish the rest of the 9 months that is left over. So with that being said, we also need to consider this factor here. So in this example, I decided to buy a machine, all right, that's worth $10,000 with a salvage value of $2,500. Its useful life is 5 years. As the number of units that it can produce is 25,000. And then lastly, the date that I placed into service is October 18th. So if it's October 18th, what can I assume, or what do I have to assume? When do you start depreciating?
November.
Exactly. We have to depreciate it the month after because it fell after the 16th. It's less than 50% of the month. So therefore, I only need to depreciate the month of November and the month of December. Okay? So again, same thing is going to go on here. We're going to determine the depreciation basis. We're going to determine the rate. We're going to determine the depreciation expense. And then we're going to consider that 2 months that that we're only depreciating. So let's go ahead and solve this. So what's my depreciation basis?
7,500.
7,500. What's my depreciation rate?
20%.
20%. So therefore, what is my total depreciation expense?
$1,500.
1,500. All right. But now, because we know that we placed the asset into service as of October 18, and we only need to calculate depreciation for the month of November and December, we only need to do 2 months. So, therefore, we need to either divide this or we need to actually calculate it, right? So we're going to take my 1,500, right? If you want to think of it this way, divide it by 12 to get you a monthly depreciation, right? Multiply it by 2 because we only are having 2 months. And you can solve it that way as well. You don't need to do 2 out of 12 unless it makes sense to you. And in this case, I don't want you to have it in decimal points. I want you to use straight fractions, okay? Because that's going to, save you, punching that number three a million times. That's my best recommendation for you. If it makes easier sense for you to understand it this way, divide the whole thing, because this is for a whole year, right? Divide the whole thing by 12 and then multiply it by however months it is we're depreciating it for. So whatever 1,500 divided by 12 times 2 is, what is your depreciation expense going to be?
250.
250.
$250. Okay. So now that we have that, then that means that's for the first year, because that is only 2 months worth. But we know by calculating from the previous one, right? That means every year after that, we're going to depreciate it for 1,500. Okay? So 250 is just the initial, and then everything after that is 1,500. And of course, same thing here. When we journalize for our entry here, you're going to journalize it as if it is for the following, for that year. Okay, so 250. Any questions in regards to straight line? No. Like I said, literally only takes 5 minutes to explain. It's the easiest concept and it's the easiest to calculate. And all you have to make sure that you have to do is make sure you know the difference and the separations between the 3 different methods. And because this is a combination, we've seen units of production and we've seen double declining. This is a combination of them too. It just makes it that much more easier to understand, right? All right. No questions for chapter 11.3? Okay. So now we're going to be moving on to chapter 11.4. This is the last section in chapter 11. So we're going to be talking about amortization. Amortization is just another fancy word for depreciating intangible assets. Okay? So as we've mentioned it before, right? Depreciation, amortization, depletion, they're all the same concept. We're essentially just devaluating, or in a sense, we're just using the asset, or the asset, and basically reflecting in our books that we used it. All right, and also reflecting the value that it holds as of that given point in time. So in this case, amortization, right? We use this primarily to describe depreciation for intangible assets. Okay, so as we remember from chapter 2, intangible assets are anything that we can't physically touch, right? So those kind of assets entail patents, copyrights, licenses, trademarks, right? And these kind of assets does not ever have a salvage value. Okay? What do you normally really do when it comes to actually owning a copyright or a license itself? At the end of its life, it expires, and you would have to renew the copyright or license, right? So in this case, there shouldn't be any salvage value when it comes to owning an intangible asset. Once it expires, it expires. And here's the great thing. The day that you purchase it is going to be the day that it starts to amortize. right? Just like how the day that we make a purchase of a vehicle, when we drive it off the parking lot, it depreciates right away. So same concept here. Okay, and same concept applies too. If it falls between the first 15 days, then you depreciate it that month. If it falls anytime after that, then you depreciate the following month. And the great thing about this is for this class, because it just depends on what the intangible asset is. For this class, we're just gonna know it. We're just gonna understand it as 15 years. As I mentioned before, it really depends on what the copyright, license, patent, whatever it is, because some can be 1 year, some can be 5 years, some could be even 20 years. So 15 for this class, we're going to understand that all intangible assets we're going to assume is 15 years. Okay? Just because, it's going to be based on whenever you purchase it and what agreement that you make your legal terms for. So if you're owning a patent, how long are you going to pay for it, right? Usually it's determined based on that factor. How long do you want to keep this patent for? Okay, and again, it's a legal documentation. So again, you're going to be dealing with whoever is going to be the agency that's protecting your assets. So in this case, that's what this thing is going to be. And here's the great thing. Since we got to take a look at straight line, amortization follows the same methodology as straight line. Okay? And except there's one thing. It doesn't even have a salvage value. So that means it's going to be, at the end of its useful life, it's going to stay 0. And you're going to depreciate it evenly throughout its life. Okay? So let's go ahead and take a look at an example here. So here we have a fixed asset. Okay? Are you guys still there? Okay.
Yeah, I'm here.
Okay, good. It was just very, very, very quiet. I just didn't know. Okay, so here amortization, right? We have a fixed asset or an intangible asset. We decided to purchase a patent, okay? And with the patent, it cost us $20,000. And its life, again, is 15 years. And again, the date that we place into service is as of January 5th. Most cases, whether it's a company policy, like if we buy insurance, right? Or we make purchases of something, usually we do that at the very beginning of the year anyway. So because we want to, ensure that we have all of our, things lined up, but also you want to be protected for the whole year. You don't want to just go in the middle of the year and protect whatever you can protect. But in most cases, if that was the case, then we would have to take partial years into consideration. So because it's an intangible asset, there's absolutely no salvage value. So in this case, let's go ahead and pretend this is a straight line problem, okay? So first thing we're going to do is we're going to solve for the depreciation basis. Depreciation basis is going to be your cost of the asset minus salvage value. In this case, we don't have one. So what is my cost of my asset?
20,000.
20,000. Oh, okay, never mind. 20,000, right? Depreciation rate is going to be 1 over 15. 1 over 15 is going to give you 0.066667, yada, 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 yada. So we place that right there. And of course, the expense is going to be the basis times the rate. So in this case, 20,000 times this 0.066667 gives you $1,333.33, right? So now we're going to take that 1,333.33 and we're going to subtract that out of the cost of the asset. And therefore, every single year that we amortize It's going to be for the same amount every year. Okay, so that is the concept behind amortization. We need to understand at the end of an intangible life, there is nothing at the end of the intangible life, right? Because when you the concept behind it is that every time you purchase the intangible asset, the idea is you're supposed to completely exhaust its its power until you have to go back and renew it. All right? So there is no residual value, there is no leftover value for it because the patent is based on how much you invest into it. All right? Most copyrights and licenses, right? A lot of companies they stop it and then they let someone else buy it. Okay, so that's the idea here. All right. Any questions in regards to amortization? Because the only difference here is, it's the same thing as straight line. Once you solve for one, it should be straightforward and they're all going to reflect the same amount every year. Okay. Here, we're going to recognize a little difference in the journal. It's going to be identical to the depreciation, except instead of the word depreciation, we're going to use the word amortization. So yes, you're gonna debit your amortization expense, and you're gonna have an accumulated amortization because you cannot directly write this off your intangible asset, right? We cannot. It's the historical cost. Okay. So you cannot write off directly the intangible asset. So therefore, we need to create another contra account called the accumulated amortization. And that's how we decrease our intangible assets. All right. Any questions so far in regards to amortization? No?
No question.
Okay, it's pretty straightforward. As much as I hate to say it, it's pretty straightforward. Okay, when we understand, here's a course review. Here are the formulas that are involved when it comes to straight line, and then again, same thing is going to apply for the amortization, except with a slight difference, right? You don't have salvage value. That's the only difference between the two. And of course, it's not depreciation, it's amortization, but you guys get the idea. All right? A little note here, straight line is the assumption that you're taking the cost of the asset and spreading it evenly across its useful life. And then amortization here is for intangible assets. That's it, and it has no salvage value. Okay? So with that being said, let's go ahead and dive right into the exercise here. So let me make sure I'm on question number 1. Yes, I am. So here, in this case, you purchase a coffee maker for $250. Okay, with no salvage value. Okay, and the useful life of it is 5 years, and you place and can produce up to 25,000 pots. Okay, so that means you can use it for quite a long time. All right, and you place this coffee maker into service on January 12th. So, first things first, what did I buy?
Coffee maker.
You bought a coffee maker. Okay. And how much did it cost you?
$250.
$250. And what is the salvage value here?
0.
Yes, it's 0. Okay. What is the estimated useful life here?
5 years.
5 years. And lastly, what is the date that we placed it into service?
January 12th.
January 12th. So what's our assumption here? When do we start depreciating it?
January.
We depreciate it for January. So in this case, assuming that we do depreciation at the end of the year, so December 31st. So let's go ahead and solve for my depreciation basis. What is my depreciation basis?
250.
250, right? It's your asset cost minus your salvage, which is 0, bringing you 250. And what do we know about this number? What can we safely assume about this depreciation basis? It's going to be the same for all 5 years. Okay. So what is going to be my depreciation rate?
20%.
20%. Good. And what do we know about this rate? It's going to be
Stay the same.
it's going to stay the same throughout all 5 years. So then what is going to be my depreciation expense?
50.
It's $50. So therefore, what we also know is this is also going to be the same for all 5 years. Okay? So now the only difference here, or the only calculation I need to really do, is to calculate your accumulated depreciation and your book value. So here, what is my accumulated depreciation for the first year?
50.
50. So what does that make my book value become? What is my book value now?
200.
It's 200 now. Okay. What about the accumulated depreciation for the second year? Okay. What is my previous years plus my current years?
Previous year.
Be 100.
It'd be 100. Okay. So therefore, what is my book value for year 2?
100.
Be careful. What is my asset cost?
250.
What is 250 minus 100?
Oh, I'm sorry. Yeah, 150.
It'd be 150. Okay. Good. So then, what is my accumulated depreciation for my third year?
150.
It'd be 150, making my book value. What's my book value for year 3?
100.
It'd be 100. All right. And what is my accumulated depreciation for year 4?
200.
200. And then that makes my book value for year 4 to be
50.
50. And then last but not least, what's my accumulated depreciation as of year 5?
250.
250, bringing my book value to be
0.
0. Good. So as you can see here, that's all you have to do. All right? And then here's the question here. Journalize the transaction for the depreciation for year one, for the first year and for the second year. So assuming that we ended on December 31st, what is my journal going to be? Depreciation expense, right? And then what's my credit?
Accumulation.
Yes, accumulated depreciation. Okay. So, what is my depreciation expense for the first year?
50.
It's $50 for the first year. Okay. What about my second year? What is the accumulated depreciation for? Yeah. I'm sorry. What is the depreciation expense for the second year?
Depreciation expense for the second year is 50.
Is 50. So that makes my journal like this, right? Obviously, the year is going to be different, but it's going to look identical. Okay? Depreciation, expense, accumulated depreciation, both for $50. Okay? Now, let's go ahead and go into question number 4. I threw a little twist in here, so make sure you pay attention, okay? So, let's go ahead and do this scenario here. You purchased a couch for $2,485, which includes all fees, okay, with a salvage value of $150, okay. Its useful life is now 7 years, okay. We've never seen 7 before. All right, and then you put this couch into service. Actually, no, we have. We put this couch into service as of August 25th. Assume that the adjustment entry are going to be done at the end of every month. Okay, there's the trick right there. So let's go ahead and fill out the information here. What did I buy?
Couch.
You bought a couch. Okay. How much did the couch cost me?
$24.85.
$24.85. Okay. And at what salvage value?
$150.
$150. Okay. And at what useful life?
7.
7. Good. And what is the date that we placed this as in service?
August 25th.
August 25th. So what can we assume here? When do we start depreciating?
September.
September. Okay. Now, here, let's read this carefully. How often do I depreciate this? How
Every
often? You're going to do it every month. Okay? So that means month number 1 is going to be September. All right? So let's go ahead and journalize this and let's go ahead and solve this. So what is my depreciation basis going to be?
It's gonna be the asset cost minus the salvage value.
Good. And what is that going to be?
$23.35.
repeat that again. 23.
35.
23.35. See, 23.35. Okay, good. Right? And what is going to be my rate?
This is where I get lost.
Be 1/7.
It'd be 1/7. Yes. Okay.
It comes out to like 0.14 something.
Yes, it's going to be this long number. So therefore, we need to assume that we need to place in our equal round formula. Okay. Now, of course, because we're dealing with straight line, my assumption is that every single month, right, all of this should be the same. So is my rate. My rate's going to also stay the same. Okay. Now, what is going to be my depreciation expense?
$333.57.
Okay.
50, sorry.
Well, yeah,
No.
so it'd be the rate times the basis.
Mhm.
But since we're doing it monthly, you'd have to divide that total by 12.
Correct. Right? This is for the whole year. We're not looking for the whole year. We're looking for just that month. Now, the assumption here is that because it's every month, we just need to divide that entire amount because this is an annual amount. We just need to divide this whole entire thing by 12. So, what is my actual now depreciation expense since I have to divide the whole thing by 12? Anybody? What is the depreciation expense if we're going to take that $337 and divide the whole thing by 12? What is my depreciation expense for the month?
27.80.
$27.80. Now, here's one safe assumption that we can do here. If we're dividing the entire amount for every single month and splitting it into our monthly payments, right? Or in this case, let's just say it's a monthly payment. So that means every month, is it going to stay the same?
Yes.
Yes, because we solved for every single month. So we can safely assume that it's going to be $27.80 every month. And that's exactly what we're calculating, right? September, we're going to do $27.80. October, $27.80. November, $27.80. December, $27.80. All right. So again, now here, our only difference that we have to do, or our only calculations we have to do, is just updating the book value. So as we know, for the first year or the first month of a depreciation, we've so far collected $27.80. So therefore, what is going to be my total or my new book value?
24.57.20.
24 20 24 57 20. Good. All right. So let's go ahead and solve for the accumulated depreciation for year 2. All right. So this is the previous year, so 2780 plus another 2780 gives us a total of
5560.
5560. All right. So that means, what is my new book value going to be for year 2?
24.57.20. 2429.40.
Yes, good. All right. What is my accumulated depreciation for year 3?
83.40.
83.40, making my book value for year 3 to be
23.46.
I did not get 23.46.
2401.6.
Yes, yeah. Okay. So let's go ahead and keep going forth. What is the accumulated depreciation for year 4?
111.2
Good.
and 2373.8.
2373.8. Good. All right, let's keep going. What is the accumulated depreciation for year 5?
139.
139 even, bringing my book value to be
23.46.
23.46. Okay, 2 more guys. So, what is the accumulated depreciation for month 6?
166.8.
166.8, bringing my book value to be 2318.2 or 20 cents. So then, what is my accumulated depreciation for month 7?
193.80.
190. Try that again.
194.
Yeah.
194.
Mhm. Bringing my book value to be at the end of the 7th month to be 2,290.40. So as you can see, that's all you're really doing is that every year, or I'm sorry, in this case, every single month, you come here, you're going to recalculate the accumulated depreciation and the book value because it's every single month. So, with that being said, okay, let's go ahead and continue with question number 5. Question number 5 says, record the adjustment entry for the month of August for the first year. What was my depreciation for the month of August?
0.
0. There is no entry. Good. For the month of August because we don't depreciate in the month of August. So good. No entry. Right? Because we didn't depreciate for the month of August. Okay? Now the question number 8 says record the adjustment entry for the month of September for the first year. So what is my depreciation going to be for the month of September?
2780.
2780. So depreciation expense. Excuse me. Accumulated depreciation.
Bless you.
Thank you. And it's for $27.80. All right, let me go ahead and put put this in terms of dollar value. Okay. Actually, I don't like that. I like common style. Okay, so now that we have that, so let's go ahead and answer question number 7. Record the adjustment entry for the first year, assuming that depreciation adjustment entry was done on December 31st and was calculated annually. Okay, so in terms of years, let's assume that this was supposed to be done in years. So I need to depreciate the first for the first year. So how many months am I actually depreciating?
12.
Let's try that again. How many? Okay, when did I place into service?
Oh, August.
August. Okay, it says right here that assume that the depreciation entry, right, is done at December 31st, right? And I'm assuming that this is based on an annual rate. So how much should my depreciation expense reflect if it's in terms of years? If this wasn't a monthly thing, how much am I supposed to determine it if it was supposed to be in terms of years? Okay, so just like the previous questions that I've done before, right? I'm assuming that the depreciation is done at the end of the year. In this case, I've calculated for the month. So how do I determine if I wanted it to be done at the end of the year versus at the end of the month? Okay. Let's look at this question again. Assuming that the adjustment entry is done at the end of the year, December 31st. Okay, and assuming that the depreciation was calculated annually. How do I journalize the depreciation for the first year? Okay. That's right.
So the first year would be for 4 months
The
because
first,
it was put in service
exactly.
in August. Okay.
Good. So, how do we calculate that? Simple way is obviously we've done it by month to month basis. How many months am I depreciating? 4. So let's go ahead and calculate what is 2780, right? Times 4.
111.20.
111.20. Yeah, so the answer is 111.20. Okay, so you have to make sure that you're flexible. 111.20. Okay, or let me double confirm that. 28 times 4. Yep, 111.20. That's all you have to do. All right, you need to be flexible because again, the most common ways when we do depreciation is you could do it at the end of every month, or at the end of the quarter, or at the end of the year. That's your only three, most commonly only 3 options, okay? So again, taking a look at this, if you're this is just throwing in so then you're able to recognize these things, and they're not going to be standard all the time. It's not going to be always at an annual rate. It could be at the end of the month. So in this case, it's pretty straightforward, right? If you have to do it at the end of the year, right, as an annual depreciation at the end of the year, you can assume, because we already did our calculation here, we already know what it is to do it every month. So we're just going to calculate the first, second, third, and fourth month, because we're assuming we're calculating depreciation for September, October, November, and December. So good. All right. Good job there. So last but not least, we have question number 8 here. So we have a couple minutes to go ahead and finish this up. So number 8, okay? On January 12th, you decided to purchase a copyright for $2,500, okay? And its useful life is 15 years. Okay, so what did I buy?
Copyright.
You bought a copyright. Okay? And how much did it cost you?
$2,500.
$2,500. Ooh, I put 25,000. 2500. Okay? And of course, what's my useful life?
15 years.
It's 15 years. Okay, and when did I place into service? Or when did I buy it?
January 12th.
You bought it January 12th. Okay, so the assumption here is that the day that you buy your copyright is literally going to be the day that you amortize it. Okay, so here the concept is the same as straight line. So what is going to be my depreciation basis? Yep, it's just going to be your asset cost. All right, and because we can assume this, it's going to be the same every year. So in this case, I only want 5 years. What's my rate going to be?
9.067.
Yes, it's going to be 1 divided by, in this case, what's my useful life?
50.
15. All right, so it should be 0.0066666, all that, right? And of course, it's also going to be the same every year. Okay? And then lastly, the depreciation expense. What is my depreciation expense? In this case, I'm going to use my equal round.
$166.67 or 167.
Yes, 16667. And because it's the same concept as straight line, you can assume that every year, right? Assuming that the depreciation is done every year, and we place into service as of January 12th, meaning we're covering the first year, that means we can safely assume that the depreciation expense is going to be the same every year. Or in this case, amortization is going to be the same. So again, what is my accumulated amortization for the first year? Mm-hmm. So then what is my book value as of year 1?
2333.33.
Yes, 2333.33. All right, so now let's go ahead and solve for the accumulated amortization for the second year. 33334. Good. And that makes my book value to be Good. Now moving forward, so what is my accumulated amortization for year 3?
500.01.
Good. Making my book value to be
1999.99.
$19.99.99. And then what is my accumulated amortization for year 4?
666.68.
66668. Too many sixes, okay? And then what is my book value as of year 4?
1833.32.
Good. Last one, guys. So what is the accumulated amortization for year 5?
833.35.
833.35, bringing my book value to be
Too many sixes. 16, 66, 66.
yes, good. It was 65 because you have to round here, right? We got 35 cents. So in order to make it even out to the 2,500, it is 65 cents. Okay. Good. So now, last but not least, journalize and record the adjustment for the first year and for the second year. So in this case, we know just by looking at the journal. So what is my journal going to actually look? What is my entry going to look like?
Yeah, amortization expense and then accumulated amortization.
Good. Amortization expense and accumulated amortization. And then what is it for the first year? How much was it for the first year?
It was 166.67.
166.67. All right. And of course, what is the journal entry going to be for the second year?
The same.
The exact same. And I put the wrong, no. I did it right. Okay, it's going to be the same. So I'm going to highlight that and copy that for the second year. All right. Any questions in regards to chapter 11.3 and 11.4, straight line and amortization? It's pretty straightforward. Anyways, okay. If you guys don't have any other questions, all you have to do for tomorrow is that